Hello guys, welcome to Zen Trading. Today is the 3rd of October 2016. Uh, this session we're going to focus on the momentum divergence, and we will see how to essentially use this indicator to enter and to exit a position in the market. So first thing to say is we're looking at the 30 minutes chart, and we adding the momentum, which measures the rate of change for this the chart. So what we're going to do is essentially we try to spot here, let's say, discrepancies between the price of the price action and the momentum. So in a normal scenario, what should happen is if the price falls, the momentum should fall. And if the price rises, momentum should keep rising. So what we're looking now here is essentially a place where we have a so-called momentum divergence. And when this happens, it's actually signaling that something is changing. And therefore, for the trader, it's actually a great psychological moment to start of the move, essentially. So what we're doing is we're comparing two candlesticks, normally, always, and 2 points on the chart, 2 points of the charts of the momentum, always. That's number one. So that's actually, so if you look at this chart today, as we said, we are comparing two, first of all, we're comparing two prices candles. So each one of these represent 30 minutes negotiations on the market. This is the Canadian dollar. And what we see here is, we see here that essentially that the price here for, so we're looking at a candlestick in this, and we're looking at the lows, in particular for a long trade. What we're doing here is we're looking at the lowest low, and that's actually signaling that we have a lowest low of 1.3070 and a momentum reading of minus 45. Now we go on the next candlestick, and we see that the price action has actually made a lowest low compared to the previous candle, but the momentum reading is actually gone higher. As we can see here, the reading, the close of this bar is minus 41. So that's actually telling us that something is changing here. And so what we do is here we in order to get in this trade, so this is called this divergence here, when the price makes a lowest low but the momentum fails to make a lowest low, instead it makes a higher reading, we have so-called bullish divergence. So we probably during the next days we will see also an example of a bearish divergence, but in this case we look at the bullish divergence. So what we do here is, how do we get into this trade? So we wait for the candle, so the candlestick to close. As you can see here, the close is at 76, and then we buy a few ticks above the highest high of this candle. So as we can see here, the market has a reading of 1.3078.7. So we add 3 pips on it. So we have a reading at 1.3081.7. That would be our entry point, you know. We can say to run it up to 82, just for the sake of it. So here's our long entry at 1.3082. which is above the highest high. And now what we do is we also put a protective stop here. I'm going to change the color to this, and so in case the market moves against us, what we do is we put a protective stop a few ticks below the lowest low here. As you can see, 67. We put 65, could be 64. You know, the more the merrier, really. But if we look at the differential between our entry point and the stop loss here, we have how many pips? We have 16.7 pips of stop loss. So that's our maximum loss really for this trade. And what we do is, so we know that if the market goes below this level, it will continue to go down. And so our stop, protective stop, will be triggered, and we will have a loss on this trade. But what happens in this case, just to be sure that the market is actually going in our direction, we buy a few ticks above the high, this high here. So we bought at 1.3082, and then we let this trade run its course. Now, where do we actually, if we want to use the momentum to time also our exit, we can see that you know, the market is actually, as you can see, the momentum is going up, is crossing the zero line, and this crossing is actually pretty much a bullish indicator. But we, as you can see here, if we were entering at this level, when it crosses zero line, we would really pretty much miss most of the move. Therefore, entering on a bullish divergence is a much better, better way to get into. So what we do is, as you can see here now, how do we get out of this trade? When we stay in the position, when we get out. As you can see here, the market is live and is actually now retracing from the highest highs. But what we're doing here is we let the market play, and we compare always we always compare two candlesticks, and we always compare two peaks or two lowest lows here of the momentum. So what we do here is we look at this candlestick here. It actually makes highest high with a momentum of 37, and so we let the position run. Something happens here when we look at the momentum. The momentum has a reading of 54 almost, but and here is the interesting part. The highest high is 1.3141, which is lower than 43, almost 44. But here we can see that the momentum has actually increased considerably versus this reading here. And here the market makes doesn't actually go above this candlestick here. So if everything was going well, what would be the normal scenario is that with this kind of reading here of 53, 54, we should have had, I don't know, a market reading of 1.3160, but we don't have it, and so something is fishy here, and this is actually telling us that there's something wrong with this rally, and so the rally is coming out of steam, and so this really tells us really in an accurate way what's happening inside the market, inside the psychology of the market. Something is changing. The price has made the low is high, but the momentum has made a higher reading. So this is called a hidden divergence, and therefore we exit the position really. At least we could have gone into a short, but for the sake of just avoiding this trade, in fact, it's much better to get into a trade short when we have a bearish divergence instead of a hidden divergence. So what we do is here, as you can see, the close price is at 1.3137, and we sell this position. So we sell our long. So at one spot, let's see, 13137 minus 13082, and so we have 55 pips less the spread, obviously. So probably for Canadian dollar is a couple of pips, depending on the broker that you're using. So let's say 53 pips, and that's really, if we consider that for a day like this, which really is a choppy day, if we use this divergence to get into the exact psychological best price, we actually can make money and make 50 pips, which is quite a lot, especially if you using a leverage of 2. That's actually in absolute terms, that's equal to 0 plus 0.50, so it's less than half a percentage point. If we're using a leverage of 2, this little movement here would represent a 1% move. So that's quite a lot of money to be made for an intraday move. And if you consider that the price hasn't really, now it's time, as you can see here, is in London is 9.27. So if we're looking at our opening price, really it's the market it's gone nowhere really. It's just a flat line, but we can use these movements and exploit this volatility to our advantage. I hope you enjoyed this tutorial. Bye bye.